Hey everybody, it's Professor Moore, and I wanted to talk to you a little bit about Chapter 4 and closing entries. So what we need to learn about closing entries is we are closing our books out. So up to now, we've analyzed what went on, we journalized it, we wrote it down, and we took those journal entries and we posted them. We made our T accounts, remember, and then we made a trial balance and we made financial statements. You did journal entries, you did adjusting journal entries, you did financial statements, and now we're going to close the books. That's what we call it. Because if you think about it, think about in 2019, if I had all this income in 2019, do I still have that same income for 2020? No, I have new income for 2020. So I need to close out what happened in 2019 and get it to be zero to start again in 2020. How do we do that? We do that with a series of journal entries we call closing entries. And if you look, I'm going to share my screen real quickly. If you look here, this is your book. This is, hold on, I'll tell you what page it is. This is page 134. You'll see it right there, 134 in your book. So if you look right here, this is what we're talking about, temporary and permanent accounts. Temporary, sometimes we call them nominal accounts. Those are accounts that we close at the end of every period. Your revenue, your expenses, your withdrawals, and your income summary. We close those out. Permanent accounts, things like assets, liabilities, and capital, we do not close those out. Think about it. If I own a truck at December 31st, 2019, do I still own it at January 1st, 2020? Yes, that doesn't change. But so those we do not close. But our temporary accounts, our revenues and our expenses, and our withdrawals, remember that's sort of a part of capital, but we do still close it. And this account that we call income summary, y'all see that right there, income summary that we use only for this closing process. So hold on, I'm going to roll down here a little bit. This right here, let me make this bigger. Whoa. This is your 4-step closing process. This is what you need to know. This is how it works. First, we close our income statement credit balances. What's the income statement? Remember, income statement is revenue minus expenses equals net income. But what are those credit balances? Revenue. Remember? So we're going to close out our revenue accounts. If those are credits and we want them to be zero, what do? We debit them. I'll show you how that works. Give me just a minute. Second, we close our income statement debit balances. What's on the income statement that's a debit? Expenses. So we're going to credit those to get those to zero. I'll show you how that works. Third, we close our income summary account. Your income summary is that account that we make just for this closing process. And then we close any withdrawals. So let me show you a little bit about how this works. So we'll go back to that. Say we have a company right here. Y'all see that? The XYZ company, okay? And they have revenue of $12,000, rent expense of $6,000, and salary expense of $4,000, okay? Right? This is their trial balance. It's just a little partial one. Now, if the first thing we're going to do, we're going to close, y'all see that? Yes. First thing we're going to do, we're going to close our income statement debit or credit balances, right? Right here, revenue, $12,000, okay? Now how are we going to do that? Right here, revenue is a credit, right? It's kind of backwards, but so right here it's a credit. What are we going to do? We're going to have to debit it right here, but we want this account to be zero. So we're going to debit that, okay? $12,000. Oh, can you see that? I'm trying to make it so you can see it. So we're going to debit revenue, and we're going to credit an account called income summary. Right here, this little journal right here. We're going to debit revenue and credit this income summary for $12,000. We can get this to zero. Okay, then what? Then our next step, remember, is to close those income statement debit balances. What are those? Your expenses. So I've got rent expense of $6,000, salary expense of $4,000. I want those to be zero. What do I need to do? I credit rent expense, $6,000. I credit salary expense, 4,000, right? So these are zeros. Now, how do I make that journal entry? We credit salary expense. I'm writing it down here. 4,000. Rent expense, 6,000. And income summary is 10,000. Because the 6,000 plus the 4,000 is 10. I'm going to debit income summary for that total, and I'm going to credit the expenses. The rent expense is 0, salary expense is 0, revenue is 0. That's what I want. Then I have to do step 3. Step 3 is close that income summary account. So you have to make a little T account for income summary and post these journal entries. So how do we do that? Well, right here, what do? Right here, we credited income summary 12,000. I'm going to write that down on my T account. Then what did we do? Right here, we debited income summary 10,000. Write that down on my T account. So here's where I am so far. I want this to be 0. So what do I need to do? I need to debit income summary $2,000. So debits equals credits. So debits minus credits is 0. See that? I need to debit it $2,000. I'm going to debit income summary $2,000. And where am I putting it? I'm putting it to capital. Remember, sometimes your book calls that equity. Like that. I'm putting it to equity, $2,000. So that I have now my revenues are 0, my expenses are 0, my income summary is 0, and my capital has increased $2,000, which is basically my net income. Now, if you have withdrawals, hold on, I'm going to go back and share my screen again. If you have withdrawals, you can see right here, 4th, we close our withdrawals account. We do that, we close that out to our equity account. But if you don't have one, that's okay. You just don't have that step. And now our revenues are 0, our expenses are 0, and we're ready to move forward for the next year. Hold on, I have one more thing that I want to show you. Got to pull it up. Wait just a second, because I don't think it's in here. Hold on, I'm going to stop this sharing for just a second while I pull this up for us to make sure I pull up the right thing. No, that's not the right thing. See, that's why no. Okay, yeah, no, that is the right thing. Huh, just kidding. Okay. This is exercise. I'm going to look at, hold on, we're going to share again. This says exercise 4-8 on page 151 in your book. Okay, and I want you to look at this. Just this first part. See where you have capital, revenue, expenses, and withdrawals. Capital, just as capital. We're going to close revenue to income summary. So here we have our income summary bucket. We put our revenues, we close those out to income summary. Then we close our expenses out to income summary. Then we've got our net income or loss that we close out. We close our income summary out to capital. And then these withdrawals then are also closed out to capital. So this is a good little exercise. This is a good little thing that just shows you how that works. We close our revenue to income summary, close expenses to income summary, and we close that income summary account to capital, and then we close those withdrawals to capital. And our big effort here, what we're doing is we're trying to get all of those things closed out. Revenue to 0, expenses to 0, income summary to 0, withdrawals to 0, so we can start over again at the beginning of a new year and make sure that we're starting with good numbers. So that's what we're looking at for this week in chapter 4. So make sure you look at that. Also, make sure that you look at your smart book and make sure that you look at your interactive presentations and let me know if you have any questions. Thanks.